This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostic. A little less than 10 minutes to go here to the end of the trading day as we count you down to the close here, Caroline, well off the highs of the day.
We are, and we're currently up only about 0.5%, but we wanted to look at sort of where the rotation trade has been playing, because growth's outperformance has been narrowing, even though today we've seen big tech once again on fire, leading the benchmark S&P higher. Even though we get news of Alphabet being tackled by the DOJ, the shares of Apple, Facebook, Amazon lead us higher. Overall, growth's outperformance has been narrowing, though. People desperate to put on this rotation trade, desperate to get into some of the more, cyclical names. Certainly, transportation has been one to watch, Romaine.
Yeah, you talk about transportation, you flip up the board and you take a look at airlines. Airlines up strongly for a third straight day here. So the idea here that we are getting some sort of economic recovery, the market seems to be trying to price that in a little bit more strongly than what they had been as well. We also saw interesting insurance stocks, a lot of the property and casualty makers rallying. Travelers, which is of course sort of a benchmark for the broader industry, reporting some relatively decent earnings, giving some relatively decent guidance. The market seems to be rallying that. Travelers up 5.5%. That's pulling up the index here. Industrials also getting pretty strong bid. Again, earnings story around the board there for a lot of the names there. Also seeing the restaurant space again. Some of these small and mid-cap type names rallying pretty hard. Dave & Buster's, which we talked about yesterday, Taylor, your favorite, was up about 7% yesterday, up 8% today. In fact, up about 20-something% over the past 5 sessions here. So some of those really beaten down travel, entertainment, and restaurant names starting to get a little bit of a bid here.
I need to go to Dave & Buster's. There are way too many places I need to go to.
It's an American tradition.
I'll make it one soon. Peter Cecchini's with us, of course, founder and chief strategist at Alpha Omega Advisors. Great to have you with us, Peter, as always. Talk to us about the on-again, off-again concerns about stimulus, stalemate. Will it go into past the election? Whatever the case, the market keeps getting up, euphoric about it and then pulling back.
Yes, great to be here with you guys once again. Look, it is, for better or worse, it's a market that's being, driven on headlines for or against, if you will, stimulus. And I can understand why that is, because when we look at the fundamentals right now relative to the recovery is slowing. COVID-19 cases are reaccelerating throughout most of the United States. And the prospects for earnings growth, in my humble opinion, is not very good. And even when we look back in time, we look back to the beginning of 2018, well pre-pandemic, there was a lack of earnings growth for both large and small caps. So really, at the end of the day, stimulus is what it's all about. It feels to me like both the Democrats and Republicans are setting each other up for the fall. That is to say, they both realize that not getting stimulus done before the election poses political risks on both sides. And so there's going to be an awful lot of finger pointing going on if it doesn't happen. And at this point, it feels to me like the pragmatic outcome would be to at least get something done before the election to avoid that sort of finger pointing. But I think the markets have priced that in at this point.
Well, yeah, and interesting you say that. This is a day, though, where we've heard from the Democratic leader Chuck Schumer in the Senate, basically saying that he doesn't anticipate getting anything done prior to the lame duck session. And now we're getting word that Mitch McConnell, according to the Washington Post, is telling the White House that a pre-election stimulus deal is basically a trap being set up by the Democrats. So it'll be interesting to see whether they can wade through the politics to get down to the money. I guess when you talk about the health of the economy, Peter, and whether it can continue on without a fiscal stimulus, without some sort of major economic relief package, what's generally your base case now for the economic recovery and how much further it can go without any additional aid?
Yeah, thanks, Romaine. I think, look, when this all started, it was difficult for any of us to really understand just how massive the impacts of the virus would be on employment and on the economy. And I will say policymakers did a very good job, with a $3 trillion plus stimulus package, well coordinated with the Federal Reserve. That was a merger that was in particular very successful. But without the stimulus, the drawdown to GDP could have easily been something like 15%. And it likely will still be about 5%, which was my guesstimate at the time that it all began. The issue now is how much more can stimulus really do? The low-hanging fruit has already been picked. And it's pretty clear that many of the programs that are most needed relative to the Main Street lending program, for example, that stimulus is simply not getting to smaller businesses for lots of different reasons, because it works through the banking channel. And let's not forget, Main Street lending program is another program that is Treasury and Fed working hand in glove. That's not to say that more stimulus shouldn't happen, but I'm just somewhat skeptical that relative to corporate America, it's going to be particularly efficacious given the challenge of actually getting it to who needs it.
Yeah, we're peppering you with a lot of questions about what's going on in Washington. We do want to get your thoughts on what's going on in the market. We're going to continue this conversation with Peter Cecchini, founder and chief strategist at Alpha Omega Advisors. But I want to jump over to Taylor right now, because we are awaiting several earnings this afternoon that will kind of kick off, I guess, what would be, the tech sort of portion of this earnings season, right?
And it's all about both earnings and tech for me in this next chart. So thank you for setting that up very nicely. This is according to JP Morgan. They're saying that right now we're in peak tech earnings, but after this could be the trigger of that rotation over into some of those underloved stocks, mainly value. So JP Morgan strategists looking at the 12-month forward earnings per share estimates. The NASDAQ 100, those have lagged those of the S&P 500 since August. So really starting to see if this is the trigger of that broader rotation underway. And then it all comes back to the current earnings, which Snap, Netflix, of course, are two that we're looking at after the bell. Snap has been smaller, of course. So let me look at this. Analysts really looking for a 5.7 million net additions for daily active users. The share's fading into this closing bell here, but you want to look about how you monetize those users, namely with the digital ad strength in what has otherwise been a different ad market in this pandemic. And then finally, though, outside Snap, outside Netflix, of course, the chart of the day, the story of the day is this Google DOJ antitrust suit. Take a look at this next chart, falling below the 50-day moving average. The summer high for Google was 1717. That's going to be the next key resistance level. Today, if we're very, very near that 50-day moving average, the next support below that would be 1400, which is where we were in September. Peter, let me bring you back in this, not necessarily on the technicals, but how you think about some of these headline risk scenarios, namely today with that DOJ antitrust lawsuit, and then how you try to fold in analysis of some of the parts versus conglomerate discount.
Yeah, the situation with Google, and I think Mr. Cohen made an interesting argument, I think is different than many of the larger and broader antitrust suits that we've seen over history, in that it does appear to be something more of a competitive marketplace than in other instances where the DOJ has filed suit. All of that said, the suit introduces a considerable amount of risk into the large cap tech space. Google being in something of a different position than many others. The other top 5 or 6 names that have performed so well. But the fact of the matter is it wasn't going to take much, in my view, to sort of knock down the tech rally. It was quite tired, and this takes me to this idea that really there's almost a forced rotation into small caps, because or cyclicals for that matter. When you looked at the transportation index, which Romain brought up a few moments ago, it's pushing into new highs and may have even made new highs, whether you look at the IYT or the Tran index. And I don't think that that's sustainable, because you must then make a bet, if that rally is to be sustained, that we are on the other side of the credit and economic cycle. And I just don't see how that can possibly be the case, given that my view is defaults will start to pick up, will begin to accelerate, for that matter, in 2021.
And so at what point have you been saying it's time to get into these cyclicals? Is it time to rotate? It's trying to get into the small caps? Or have you been saying, no, hold your fire, wait until we get through this default season and until we start to see the real ramifications of a no lack of stimulus kind of economy?
Yeah, no, Caroline, I've certainly been on the side of hold your fire, and one of the key areas within small caps that I think we have to look at are the small cap banks. Regional banks and even large cap banks in particular have underperformed almost every other sector, and I think that's a really important tell, because the transmission of stimulus is typically through banks, whether we like it or not. And in particular, commercial real estate is just in the early innings of the stress it's about to feel. Many of those banks hold those assets on their books.
Yeah, so we are awaiting Netflix earnings. Appear to be crossing the wire right now. Netflix 3Q EPS coming in at $1.74, so above the $1.47 year-over-year number. So a beat, so not necessarily a beat, excuse me. Let me rephrase this. 3Q EPS, $1.74. Estimate was for $2.13. 3Q revenue, $6.44 billion. Estimate was for $6.38 billion. So a slight beat on revenue, a bit of a miss on EPS. 3Q streaming paid net change, Caroline, coming in at about 2.2 million. The estimate was for up 3.3 million. So a miss on streaming paid net users in the third quarter.
And a look ahead for the fourth quarter streaming, the market would wanted to see about 6.5 million being cited as to be added in the fourth quarter, and they're saying, look, it's going to be 6 million. This is a company that, like Goldman Sachs was saying, this third quarter is going to have 6 million net additions, and it doesn't. It's well a third of that at the moment, and clearly they are conservative often, and in fact failed to beat once again. And this is something we tend to see. I mean, they've missed their forecast for net additions in 3 of the past 9 quarters, Romain.
And you wonder if the expectations here were a little bit too high. I mean, we saw the shares drift lower today, but keep in mind, since that last earnings report that we got back on July 16th, the shares really hadn't done much. I mean, the biggest gain they had from peak to trial was about 5.5%. And prior to today, it was only up 1% from that time. So investors had pulled back a little bit here. And the general idea was all the binging we were doing, all that subscriber growth that we saw in 2Q and 1Q, that folks really wanted to see that repeated, really going into 4Q and beyond. And it doesn't appear they're going to get that.
And Taylor, we should look at chip stocks, because I know this is something that you've been pointing out. The stocks at record high. For example, Texas Instruments seeing its fourth quarter revenue 3.41 to 3.69 billion, ahead of the expectation for its fiscal fourth quarter. Its third quarter revenue coming in at beat. It's 3.8 billion, whereas the expectation had been for 3.45. And the earnings per share also coming in ahead of expectations. So the chip stock, we've been high hopes for Texas Instruments, and it comes in strong, Taylor.
Yeah, unbelievable. Let's pull Peter back into this conversation. As you think about peak streaming wars, right? Peak streaming and some of the lack of subscriber additions after a big first quarter, a big second quarter. Are you worried that we just pulled forward demand and we're not creating new demand as fast as we should be?
Well, look, that's Taylor. That's the $60,000 question for anybody who's trying to analyze just about anything, whether it be Netflix, a tech company, or the economy more broadly, for that matter. How much is being pulled forward by this extraordinary situation that the pandemic has created for companies and economies? And I'll tell you, it is interesting. You know, that uncertainty was interestingly priced in by the options market, with the average move on the stock after earnings of about 4.5%. And if you looked at the money straddle, it was implying a 9.2% move. And so it'll be interesting to see whether or not the options market got it right. But it was rightly expecting a lot of volatility, because it's just so difficult to estimate how much demand has been pulled forward.
And in terms of what the options market is currently telling you, in general, are you seeing signs of a whale back? Are you seeing technology being bid up too high? Apple moving at 1.6% ahead of its main phone unveiling. There has been talk of too much use of the options market, and call options in particular.
Well, it's interesting because, you know, there haven't been very many markets that are telling us very much of anything in sort of a predictive way of late. And the reason for that is because the Treasury market is highly manipulated now. The bond market, the corporate bond market, is highly manipulated right now. And the options vol market, though, has not been directly acted upon by policy makers in any way. And so when you look at volatility, whether it's index volatility, let's call it on the Russell, for example, it's extremely elevated, and I think rightfully so. If you look at S&P volatility, it remains highly elevated, despite the fact that the underlying, that is the S&P itself, is very close to its old high. And so you can say that across the board. And I think, you know, that's something that we really do all need to pay attention to. And from a practical standpoint, it actually makes it very, very difficult to hedge out risk, because vol across the board has remained so expensive.
Yeah, Peter, I am curious. So, I mean, there are a lot of folks out there that still want to put their money to work. And I guess the question that seems to come up all the time is, where do you go with stocks at valuations that are somewhat questionable, with treasury yields basically near historical lows here, and even in corporate credit markets that seem to be stretched a bit depending on which corner you're in. I mean, where do you look for opportunity now if you don't want to be on the sidelines?
Yeah, Romain, I don't mean to be hyperbolic about it, but certainly in my investing career, this is one of the most difficult times to assess where one ought to try to go. I have liked gold really for about a year and change for lots of different reasons. In a low yielding environment, gold, I think, does provide an interesting store of dollar value that doesn't have a treasury contra liability. So I have liked gold, but I mean, that seems like a pretty uninteresting answer to your question. I just really can't find anything that I love, except, and I will say this wholeheartedly, in the alternative space where there is this bifurcation between private and public markets. The stimulus has had a difficult time getting into the private markets, and the loan market in particular. There are good companies that are having liquidity issues, which are going to turn into solvency issues, and which will provide opportunities for astute investors in the alternative space to take advantage of. So, unfortunately, it's not the broad asset class allocation conversation that would be easier for our conversation on air, but it's a much more case by case specific kind of analysis now on a company by company, opportunity by opportunity basis.
Fascinating stuff. Great to have you with us on this day of earnings. Peter Cecchini, founder and chief strategist at Alpha Omega Advisors. We update you, of course, what's happening with primarily due to their first half and the pull forward effect. We're going to be getting our